Hello, everyone. My name is Blake Hutchison, and I'm here representing Flippa, the largest platform globally to buy and sell online businesses. And I'm also joined by Mushfiq Sarker, who is the founder and CEO of WebAcquisition. In fact, he's the founder and CEO of many businesses. So a very big welcome to you, Mushfiq. I can't wait to spend some time with you today. How are you?
I'm good. How are you, Blake? Thanks so much for having me.
It's great to see you. Now, for everyone out there who is wondering what we're doing on today's session, we're going to be talking about buying digital businesses, which of course is something we always talk about, but we're going to do that in the context of one, the AI era, and then two, due diligence specifically. And so Mushfiq is an expert. He'll talk you through his credentials. He'll walk you through WebAcquisition and their service proposition. And then we're going to dig in to how the due diligence process plays out generally, but also how the due diligence process plays out in the context of this new and evolving space we all are living in day to day, which is the influence of AI on the businesses that we run. So for those of you who are less familiar, Flippa is a platform to buy and sell online businesses. We work across all of the different digital asset types. We have iOS and Android apps for sale. We, of course, have blogs that are available for sale, e-commerce, SaaS, YouTube channels, Substack and Beehive newsletters, and an evolving AI first, an AI native business category as well. We do just in excess of 6,000 sales per year, which means that all over the world, there are happy entrepreneurs exiting and those going on to their acquisition entrepreneurship dreams. And for those of you who are wondering, there's typically three types of buyer. There's someone who we might determine to be a side hustler. They're looking to buy their first thing, generate some cash flow, some income from something they do on the side while still probably going to work each day. We have the acquisition entrepreneur. They're essentially buying their next job. They want to earn a full-time salary from the business that they acquire. And of course, we have company/institutional and small business buyers. Those are obviously entities, and typically the person on Flippa is representing an entity, and they're buying for a number of different reasons, but strategic reasons, inorganic growth reasons. Perhaps they want to own a community. Perhaps they're looking to bolt on some additional revenue from something which is complementary. All right, let's start with the very basic. Mushfiq, would you mind introducing yourself and the business that you run?
Sure, yeah. So my name is Mushfiq, based out of Chicago, US. So I got my start on Flippa actually in 2008, 10-ish area, where I started to buy online businesses, bought a lot on Flippa, over 100 transactions on Flippa. And so we usually were buying businesses for our own portfolio, but over time, a lot of people reached out for due diligence. It's a very critical aspect. It's an aspect, if you skip it, you could buy a bad business. It happens all the time. So about 3 or 4 years ago, we launched WebAcquisition, which is our M&A firm, where we do buy-side due diligence for online businesses only. So that includes technical marketing analysis reports, that includes quality of earnings, financial analysis. That also includes deal sourcing for folks who want the hands done for you approach, where we find the deal for them, and we find 80% of our deals on Flippa itself, and then essentially consulting as well for those who just want to talk to a strategist or M&A firm in general. So that's our service offerings, and we've been doing it for about 3 or 4 years now as a firm.
Awesome, Mushfiq, and congratulations on everything you've achieved. Obviously, we love you as a community member, but we now have also integrated WebAcquisition into Flippa proper. So for those of you who are unaware, when you're looking at a deal on Flippa, you'll tend to be inquiring in what we call the deal room, which is an environment where you can talk to a business broker and also talk to the seller direct. Mushfiq's business, WebAcquisition, is now integrated right within the deal room. So you click the verification and analysis tab, and you'll see WebAcquisition right there and accessible to you all as you go through that deal making process. So hopefully that is more convenient, because we often get asked, who can help us with due diligence? And of course, Mushfiq's company can. So Mushfiq, what a wild world. You and I have been in this for a long time now, and we have seen technology disruption, but not anything quite as substantial as what we've seen over the last 12 to 18 months.
Right.
It all kind of started with, I guess, the helpful content update where Google made a change to the way they perceive content on blogs.
Right.
And that disruption has now flowed through to so many different assets. So I guess the very, beginnings of our session today, generally speaking, what have you seen play out over the last 12 to 18 months in the line of work that you are participating in?
Excellent question. So I got my start with content websites. So media content websites monetized with ads, affiliate marketing, ranking in Google, bringing in traffic. So that helpful content update was big for personally me and for the industry as a whole. Majority of our due diligence requests for clients were content sites. I am known as an expert, let's say, in content site space, and that has transitioned slightly over the last, let's say, 2 years from smaller sites, say sub 200,000. Now we're doing content site due diligence for sites 1 million, 2 million, 3 million. So there is a point where content sites are still working well. So to your point, there are bigger deals, bigger sizes. It's hard to take down something that's been around for 10 years, has a community, has email lists, has paid ads, has an ecosystem of different ways to bring traffic. So we are still doing due diligence for content sites, just bigger and bigger deals. So over the 12 to 18 months, a lot has shifted to people buying e-commerce. That's still strong. Content sites that are big, software companies that have so that's another thing. Probably we'll talk about how AI has kind of revolutionized coding and development of software, but people are buying SaaS that have marketing channels left that have not been tapped into. So we go in there and analyze and figure out which marketing channels have the best ROI, like where they can put money into and grow that. So I'll stop there, but it has changed a lot, and we're seeing different types of deals that people are interested in now.
Fantastic insight. And obviously, Flippa has sold a lot of content sites, but as the market has shifted, buyers have changed what they want to look at. And as a result of that, a lot of the supply has shifted on Flippa as well. Now, when I talk about supply, I'm a marketplace CEO. So what that really means is the business owners listing their businesses on Flippa. And so just in the context of that, we'll get straight into some insights. I'm going to quickly show you a crazy shift we've seen in some of the search behavior from buyers on our platform. So you can see here that in the last 3 months, there has been a fairly aggressive push toward e-com and YouTube channels. Essentially, with a YouTube channel, you're buying a community, just for everyone's benefit. Now, AdSense, which is the monetization for a blog, is still in the top 3, and there's still a great deal of demand for that. What we have seen slip, which is analogous to the public market sentiment, is this SaaS decline here. So it's not that we don't have buyers for them. There's still, in the last 3 months, a good number of buyers looking for SaaS assets, but the actual number of direct searches for SaaS assets has declined substantially from where it was at 12 months ago. So, pretty cool to see a move in the appetite toward e-com and a move in the appetite of buyers toward YouTube channels. I think the really obvious question here, Mushfiq, and it's a really broad one, so please feel free to take it wherever you like. But what does safe buying look like today, in your opinion?
So safe as in buying a stable business, right? Yeah,
which assets, and then what to look out for in those assets generally before we dig into really specifics.
So I'm going to answer that a little differently. What I'm looking for, I'm an acquirer too, right? I buy 5 or so businesses a year and then help others. So I'm a buyer and a consultant as well. So what we look for personally are businesses that have a stronghold on a marketing channel, right? Because you're buying eyeballs when you buy a business, online businesses specifically. So we're looking for a stronghold. A stronghold could be time, like 5 years of history of organic search traffic, or they figure out paid advertising where the return on ad spend is high, or the return on ad spend is high. And then also maybe an email list that consistently has been emailed to is large enough to bring a return on investment as well. So we're looking for those because that's hard to build, and we're looking secondary on the type of business. So we're business agnostic, and I think in today's environment you kind of have to be. You have to be business agnostic. You have to be willing to buy a SaaS. You have to be willing to buy an e-commerce. You have to be open to that, but you have to find out what your core expertise are in the marketing side of things. Let's say you're good, you want to learn SEO, or you're good at it, or you're good at paid ads. You have to buy something that has that opportunity, or a subsequent opportunity where you're not good at SEO, but so you're going to buy a site that has proper SEO and proper organic traffic, and then you can tack on your expertise, which is paid advertising. So I'm looking at those marketing channels, and then secondary, I'm looking at, oh, is it an e-commerce business or is it a SaaS? Now I can do that. I have that flexibility. I have a team and expertise behind me to help. But for people getting started, obviously they always look at, oh, I really want a physical products business, and that's fine. Or I really want a software business, that's fine. But then go one side deeper and see what are those marketing channels that exist. Like even 5 or 6 years ago, prior to AI, a lot of my buyer friends or community people that I know were looking at business types, and then secondary looking at the marketing channels and seeing where the opportunities were. I think it's now a little different.
It's a great overview. So just to summarize that for everyone, you want to look for a business that has a reliable marketing channel that will continue to produce customers, and those customers continue to contribute revenue for your business. And then secondly, per Mushfiq's point, you want to think about being business model agnostic, but more orientate to your passion and your skills. If you can orientate to your passion and skills and couple that with a really strong marketing channel, you're probably buying a good business. And you're more likely to succeed if it's in an area of passion where you have the skill set to apply. Okay, so we're going to do a couple of things. We're going to talk about, generally speaking, where buyers go wrong in the AI era of due diligence. And I'll be asking Mushfiq some specific questions. We're going to break down risk by asset type and talk about e-com versus SaaS versus content and the various things that Mushfiq and his team would look at when they consider those types of businesses. And then we're going to go through a DD framework more generally and give you all as much detail as you can. Of course, the webinar is being recorded, and we can also follow up with some questions at the end for those who have those specific questions. All right, so you see a lot of deals, Mushfiq, and those people who don't do due diligence, please just stop that and start to do due diligence, because it's a safer way to buy and protect your return on investment. So let's just start with the very high level. What are the most common due diligence blind spots that you see?
No, great question. And first, customer concentration, right? And this can be seen in different ways. If you have a software company, you're buying, how much is the top customer bringing in recurring revenue? That is always something that's easy to look at, but it's really not deeply dived on, right? Like service agencies, if you're buying a service-based agency, if your top client is bringing in 30% of revenue, what if they cancel right after, right? If you are buying a content website, you have to look at it a bit differently. Which marketing channel is the highest concentration, right? If you have 98% organic search traffic, that's a high risk business, right? You gotta have a little diversified. If e-commerce, again, same thing, which marketing channel brings the highest concentration? So you have to look at concentration on customers, customer types, and marketing channels. I think that's something you don't need a specialist to look into that, right? You should be doing, so to step back, we are brought in at a later stage, right? When buyers are looking through your platform, Flippa, they have some of the data, they get access to Google Analytics, they can ask questions. You should be asking a preliminary set of questions on, and one of them should be customer concentration, right? That's really the easiest one. If it's too high of a customer concentration, you don't need to bring us in as a third-party due diligence specialist to look into that, because that's really basic.
And so what is too much concentration from your standpoint? Like, let's say I'm doing $10 million turnover and I've got one customer doing 7 million, another customer doing 3 million. Clearly that's high concentration and probably a bit risky. What is too much concentration, and how does it differ by business model?
Right. So let me give a real example, right? So we bought a marketing agency in 2024. It was 1.3 million in recurring revenue annually in US dollars, right? Now on that business, and these are law firms, so local businesses that we service and do marketing for, right? For that, the concentration of one customer, law firm, was less than 10% recurring, right? It was like 6%. So that's to me safe, right? There is about, and then the number of customers also matters, right? So that one had about 70 clients. So that was good enough. But we have done other due diligence while we were in the market where we saw more than 30% of the revenue annually coming from one client, right? Now, that might be okay if it's a risk factor if you're okay with that, because sometimes that the relationships are built on the seller, right? The seller has built that relationship over time. You sell the business right after it. There is this weird sticky point there where it's like, is that relationship still going to hold, or was that because the seller was the owner of the business at that time? So I would say, as a rough figure, 20 to 30% or more, that's too high for me and beyond my comfort level.
Let's just say, for whatever reason, I had comfort. What would be ways I could mitigate that risk? Would you recommend trying to keep the owner on board? And have you seen deal structures which allow for that?
So two things, excellent question. So I keep owners on board on every business I buy. That might not always be possible, right? So anything that has customer relationships, right? That could be B2B software companies that, you're doing, building the relationship with C-level executives and selling them software. It could be service agencies where you are offering a service and there's face-to-face. Anything like that, I always at least give the seller 5% or more retained equity, because I need their name, I need their presence involved, and over time that could be, give a few hours a week and then that dies down. So that's just to keep their name involved on the business, right? They don't do any work, it's just for their name. Second, I put, if you're okay, if you like the business and the concentration of a single customer is too high, put an earnout on that. So you can put an earnout, say that, and let's say it's $1 million annual revenue business, 300,000 comes from one customer. Like, that's too high for me. Put an earnout on that. Say if the revenue dips by 80% after 12 months, then that earnout goes away. So that's essentially counting for that one client to go away within the 12 months, right? So you can put earnout clauses on that. You can keep the seller involved with equity. That's how I would do that.
Yeah, it's a great point. We've seen obviously lots of deal structures, and we obviously see a combination of earnout, which you've just alluded to, seller financing, which essentially allows the buyer to pay in the business's cash flow over a longer period of time, but is also a good way to keep the seller engaged, because the seller doesn't want to stop receiving those checks. So you can kind of tie some commitment back to that. And we also just see salaries paid. So sometimes a new owner will come on board and they'll say, okay, well, you are inextricably connected to the business. I now own it, but for the next 12 months, I want to pay you to do a certain job. And that could be retention of those key clients.
So we've seen, add on to that part, that part is a little harder. We've seen where most of the time the businesses are being sold because a seller is tired or they want to do something else.
Yes.
So we had less luck on keeping folks involved post-sale, unless it's on a contract. Like, there's post-sale support, 3-month support, X hours a week, that's a given. But beyond that, when we usually say, okay, if they don't want to retain equity, they don't want that, we say, okay, we're going to pay you an hourly rate. But we've had a hard time after the 3 months, most of the deals, where the person just says, I'm too busy with another project, right? So that's where that's why we're very strong with the retained equity and then the earnout, because it's tied to performance and that keeps the seller involved. Seller financing is a great way as well. They don't want to lose that money, but we've seen that it's a personal guarantee type of a structure where it's built into that asset agreement. They have to pay. It's not tied to the revenue of the business. It's tied to the buyer of the business personally. So they have to pay that or they're going to go to court, right? There's a big legal that can happen there. So it's not really tied to the performance. And so we love earnouts. We love to keep retained equity. I think that's the best structure.
Okay. All right. What I'm going to do, Mushfiq, I'm going to put you on the spot. We're just going to talk a little bit about each specific asset type. and just 2 or 3 major things to look out for in the due diligence process, and then major things to look out for in the transfer of the asset and that sort of first 30 days post access to the asset. Because the due diligence piece is obviously critical. We get to learn about the business. We get to make an informed decision as to whether we want it or not. We get to see those red flags and decide whether those things are too hard for me to overcome or reasonable for me to take on as a risk. But then one of the things that's always tricky is, I take on this new asset, and for the first 30, 60, 90 days, there's a bunch of stuff I need to take care of, like making sure I have all the assets, the customer database, the Amazon login credentials, all of those things. So just in a very simple way, I guess let's start with e-com. Is that okay, Mushfiq?
Yep. Yeah.
All right.
Yeah.
So for e-com specifically, what would the 2 or 3 things be that you would like people to keep an eye out for when they are considering an e-commerce business?
Right. Yeah. Good question. So, and this comes to the P&L, right? Cost of goods, and your gross profit margins. Depending on the business type within e-commerce, you have your own products that you have a factory for in wherever, and they're producing. I like to have 60 to 70% minimum gross profit margins on that deal. And I'll explain a little bit more on how to do that. And then if you have drop shipping businesses where you're just drop shipping other companies' products, I like to see 20 to 30%, right? Now that's really important because that is if gross profit margin is very important because that covers the cost of goods, the freight, the payment processing fees, and all that. After that is the dollars left over for you to reinvest in the business, people, advertising, software, and your own salary, right? So a lot of e-commerce businesses buyers get that part wrong, which is they buy a business with lower gross profit margins, leaving no cash flow to reinvest. So I think that's critical. And then the second one would be market channel risk. Too much on paid ads. If Google changes the algorithm, and with AI and all these changes happening now, I don't want to see more than 80% on any single any single marketing channel concentration.
And from your perspective, as it relates to e-commerce businesses, has AI had an impact in the way you would consider buying or the due diligence process through that buying process?
For an e-commerce?
Yes.
No. E-commerce, in the fundamental operations of e-commerce, AI has not really impacted because it's physical products. Obviously, e-commerce means online businesses, therefore tied to marketing channels and all of that. So that hasn't had an impact, obviously, through AI. But from the fundamentals of an e-commerce business, not really.
All right. And then if you can, and I'll provide some insight as well, once I buy this e-commerce business, what is important through the first 30, 60, and 90 days after acquisition?
Yeah. So I like to say first 30-day stability, get access to all the accounts, and get access to Shopify or WooCommerce or whatever platform is being used, get access to all the advertising accounts, get access to pretty much all the assets. And during the due diligence phase, during those 30 days or however time you have where you have exclusivity to look over the deal, ask the seller for a full asset list. And this should be for the full business, every business. This is not for e-commerce. Ask the seller for a complete list of assets and review that list of assets, because that's what you're going to get access to right after you sign the asset purchase agreement and start the transfer process. That's what you're going to get access to. And it's a checklist, right? Just go over that and make sure you have administrative access to all the accounts. So that's like right after funding the deal and you have the transfer time. And then during the 30 days, you're just making sure the revenue is coming in, everything is A-okay. You have actual administrative owner access to all the accounts. 60 days, you are figuring out easy wins. So easy wins is really important. What levers can you pull immediately to get that revenue up so you get that ROI? Now, don't make too many changes. This is a mistake beginners make. They get excited, right? I want to do this. I want to do this. Don't do that. Be within bounds. Make small changes. Do what you are good at. Implement those things. 90 days, again, it's 60 to 90 days. It's the same. Just analyze the business. It's what you're going through one quarter. E-commerce businesses are very seasonal. It really depends on which quarter you're in. E-commerce businesses, most of them do very well quarter 3, quarter 4. I would make no changes in quarter 3, quarter 4. Always make changes that you think are going to impact the business on the off-peak periods, which is usually quarter 1, quarter 2. So just be cognizant of that when you're making those changes within the 30, 60, 90-day period.
Fantastic answers. And everyone, thank you so much for your questions. We will absolutely get to each one of those. And I'm going to do that at the end of our session today. So please do keep them coming through, stay on the line, and we'll make sure we get to each of those questions one by one. Mushfiq, is there anything that you've just said about e-commerce that is different for Fulfilled by Amazon FBA?
Yeah, okay. Yeah, good question. So FBA is more different, is much more involved, right? There's a lot of different line items that don't show up on the e-commerce side. Amazon fees, freight fees to Amazon's warehouses, their holding fees, and all of those things. From a due diligence perspective, for the first two things, obviously your cost of goods and gross profit margins matter, and they matter even more for Amazon because your margins are less. But one other thing matters is Amazon Seller Central health, your account health. That's very critical. Something a lot of people miss is you need an expert Amazon FBA specialist, if you're not that, to go into the account, go into Seller Central and make sure the health of that account has been consistent for a long period of time. You don't want to buy a business that the seller of the business has done nefarious tactics to boost sales, which has raised some red flags and warning flags within Amazon Seller Central, because you're inheriting that account. That's not the same thing with like a pure e-commerce business on Shopify. With Amazon Seller Central and FBA business, you're actually buying that Seller Central account, and it's a very valuable asset. So you really need to know what you're doing there.
Okay. Let's talk a little bit about content. It's obviously gone through an extraordinarily aggressive period of disruption. However, good content sites are still good businesses.
Yep.
And those businesses that have been able to retain, and in some cases even grow their traffic base,
right,
remain healthy businesses and legitimate prospects for buyers. So let's talk a little bit, if you can, generally speaking, what have been some of the AI disruptions for content businesses? And then what do you look at through the due diligence process?
Yeah, the biggest disruption. So when we say content websites, the traditional sense is that it's a website that has content that's monetized by, can be digital products, advertising, affiliate marketing. Pretty much in this world, it's called a middleman, right? You are funneling traffic from Google or other platforms to the website and then making some money. So Helpful Content Update was a big update that Google put out that decimated this content site industry. That was a couple years ago. And so that's the big change. The sites that survived were sites that I wouldn't say did things right or wrong. They just had a stronger community, as in they had multiple traffic sources, not just reliant on Google. They had email lists, they had social media. They essentially had a brand. That's what was missing in this space. You would see 1-year-old content sites making a couple $1,000s being sold. And that wasn't a brand, right? That was just a middleman trying to make money. And there's nothing wrong with that. That happened, that worked for, I mean, I've been in the industry since 2008 doing that. So long time. That has changed significantly. And now we're seeing sites that, content sites that are making, let's say $50,000, $100,000 a month, right? And they have multiple revenue streams from different sources. So they're more of a brand, providing a real service to the community, to Google, essentially.
I completely agree with everything you've said. The average transaction value for content sites has actually increased on Flippa because the ones that are small are not trustworthy enough to buy any longer, and they're too easy to disrupt. And the ones that are big, with a decade's worth of community building history, have demonstrated longevity, and there's more buyer interest in those types of assets. Obviously, harder to afford. Bigger deal values, but generally speaking, if something's been around for a long time, if it's consistently performing, if it has not plateaued and or declined as a function of the Helpful Content Update, it's somewhat more of a sure thing. Okay, and then due diligence. So you no doubt receive huge numbers of buyers come to you and say, "Hey Mushfiq, hey WebAcquisition, can you please do due diligence on this content site?" What are you now looking for?
Right. We're still looking for the SEO, looking for full analysis of SEO to see if any bad things done in the history to essentially put the site in a gray area that could potentially kill the site down the road. So we're looking at that. We're looking at traffic diversity. Whenever a client reaches out to me and I see, 80%, 90% organic search traffic, I just tell them, look, I can do due diligence for you, but I'm going to say this is a bad deal. Like, I just say that, like, from a buyer's perspective, you shouldn't buy that if you have no experience with that. So I'm looking at market channel risk. I'm looking at diversification of market channel, and I'm looking at revenue stream diversification. You don't want to, you don't want two of those working against you. You don't want one market channel that's getting majority and then one revenue channel getting majority, because any one of those go down and the business goes down, right? So I'm looking at both of those having a good diversity.
And so, I'm the CEO here at Flippa. We're looking for new and great ways to grow our business, and we are pro AI. We use it in everything we do. Right. And so, is there actually an issue with a content site owner using AI to build content and better optimize their business? I'd say,
yeah.
It obviously depends. What's your perspective?
Yeah, it depends. We do it with a human in the loop, I should say. So we use the tools to generate 70% of the work, and then we put an expert to do the remaining 30%, 20%, right? That's the editing part, adding insights that AI can't capture. So when AI first came out, there was an influx of websites publishing just AI garbage content, right? And just no editing, just mass publications of publishing of content. That doesn't work. It can work for a short period of time and then it just dies. That's not a business model. That's just a get rich quick scheme. It can work, right? But if you put a human in the loop, have a proper review process, it's a good strategy. We do it as well.
Let's talk about SaaS a little bit. Obviously, the public markets are suggesting the SaaS apocalypse is alive and well, that investors are less likely to invest in SaaS businesses because apparently vibe coding can replace the entirety of the Salesforce ecosystem of 6,000 apps. But anyway, I don't think that this is real. I think that those businesses are stable. They have entrenched customer base. They have hugely dependable workflows and apps and integrations, which make them less susceptible to vibe coding. And it's highly unlikely that a CEO suddenly says, "Look, I'll put my engineering teams on building a CRM versus features for the business." Now that differs for a small SaaS business, because obviously it doesn't have the sort of the balance sheet, the cash flow, the customer base, the brand, the distribution.
Right.
How do you think due diligence has changed today for SaaS businesses?
Yeah, good question. So SaaS, pre-AI, SaaS was getting the highest multiples, 5, 10x annual. Any SaaS, they're just selling quickly and everybody loved the recurring revenue. So what has happened now? You can vibe code a lot of this stuff. So what we're looking in the due diligence aspect is how replicable is this business, right? There is software you can replicate very easily, right? There's a lot of, for example, there's a lot of social media scheduling tools, right? These can be pretty much built in a sense, the technology pretty quickly. What's hard to do is replicate the customer base, right? To get the eyeballs on that app. So really in today's environment, I see people buying eyeballs, right? And I said that initially, it's a SaaS platform that may have been around for 5 years, but has hundreds of thousands of traffic coming to it, right? That's hard to rebuild. That is the asset. The software is no longer the asset, which used to be the asset. Now it's the marketing channels, the distribution of the brand. That is the asset. So that's what has shifted now. What we are seeing trend is people are buying more sticky SaaS businesses, as you said, more B2B focused, things that really you cannot replicate because it has, it's integrated within that business that's buying that SaaS so strongly that you just cannot just remove it overnight, right? So those are the ones that I highly recommend people look into, and those are still trading at very good multiples.
Let me ask you a direct question, Mushfiq. Has your appetite for acquisition of businesses shifted as a result of the influx of vibe coding tooling?
Yes. So we have a process, and we like to buy, and this is internal, it can be any type of business. We like to buy high revenue, low profit businesses. All right, let me explain that. It's like high revenue means more than $1 million, and then on paper, low profit, because I can buy that business on a multiple of profit, but revenue is hard to replicate. Anything high revenue means eyeballs, and it's hard to replicate overnight, right? So I buy high revenue businesses, low profit. We get in there, and I have a dedicated team within 6 months that cleans up that P&L, right? That could be operationally optimizing some a very high cost line item in the P&L with AI software. So we build a lot of the AI software in-house and then clean up that P&L. And that could be, if it's optimizing something or letting go some clients, letting go of some employees that may not, be needed. So cleaning up that P&L. So that's what we like to do. So AI has helped us operate our businesses better internally. So we don't really use AI to launch new SaaS products. We just buy businesses that need AI in another word.
So I agree with what you've just said, which is that I think people can build almost anything now. So we all know that. That's what most of the news is spouting, and I agree with it. But just because you can build almost anything doesn't mean you can generate the revenue that these great businesses have been able to generate over a period of time with an established community, with a brand, with a good product, and an ability to turn that product into a paying customer.
Absolutely.
And so if something earns $1 million, that's pretty impossible for you to suddenly think you can vibe code all of a sudden. If something earns $100,000, that's almost impossible to think that you could suddenly vibe code all of a sudden. Absolutely. Yes, you can build what they built and take it to market, but now you're dependent on how good you are as a marketer, acquiring customers efficiently, and then turning those customers into paying customers. So that's
what I like to tell some of the buyers that come to us. You are buying the seller's past ability to bring eyeballs and marketing to that business. You're not really buying the assets of the business, because in today's environment, as you said, that can be replicated pretty easily. You're buying that history of eyeballs that came to that business and the future eyeballs that will come to that business.
Okay, we're going to talk a little bit about misleading signals and some of the buyer mistakes you see.
Right.
And so I guess the very basic and obvious question here is, what are the most common, it looks great on paper signals that are quite misleading in your opinion?
So on paper, whenever somebody looks at a business on Flippa or anywhere else, you get the P&L, right? Usually the P&L from Flippa, it can be through help with your internal brokers that help you put that together as a seller. It can be seller provided P&L. And if it's a third party marketplace, another brokers, usually the brokers do that. The biggest mistake I see is the buyers take that as face value. Like, that is true. Hey, the P&L says it. It's not true, right? We hope it's true, but oftentimes, if you've run a business in the past, bookkeeping is hard. You can't find a right bookkeeper. The owners of the business do the bookkeeping. So there's a lot of miscategorization, misleading costs, things that are missing that should be in a P&L. So that's the first thing we do in due diligence, is look through the P&L and see what is missing. And cost, there's a lot of line items and cost of goods that are missing or miscategorized, right? So that's something, whenever you as a buyer looking at a business, look at that P&L as something that's a red flag to begin with, right? Your job is to find mistakes there and then go back to the seller and say, hey, what happened here? This line item is missing, right? And that's something we help with, but essentially you should have that skill set to pick those line items out or what's missing and bring that up to the seller broker.
Okay. And what's one red flag that you've seen recently that probably would have passed due diligence in the past, but now today you perceive it as different?
That is a good one. In the past and now. I'm not sure about the past, but one thing we looked at just last week, buyers are, let's say, naive, right? They think they can acquire that business and the cash flow will keep coming. The things that we catch is workload, right? Workload of the buyer after acquiring a business. Sometimes, like we're looking at a deal now, it's on Flippa. And the business, the individuals that were with the business were a part of the sellers, their family members, right?
Okay.
And there's a stipulation in the CIM and the essentially document that says these individuals will leave right after. And my buyer was under the impression he can just hire staff like that, right? And I'm here telling him you can, but you don't have the expertise to hire that staff. You've never run a business. So our job is to push back with the seller and say, look, you didn't even include these cost line items in the P&L, like a social media manager or a paid ad special. Like these are people that used to help you run the business. You're not including in the P&L, so it's showing more profits on the P&L than in reality after acquisition. And so we're going there and pushing back and say, look, there's like $5,000 a month of missing labor costs in there. So that's maybe not a past issue, but it's a very common issue because the seller is trying to get the maximum valuation by cutting out costs that he thinks are not necessary, but the buyer and us thinking, oh yeah, we need these people, or we need these costs in there because that's what we're going to incur post-acquisition.
So we're going to get to some of the questions from the audience here, but you are actively looking for deals all the time, and you're a due diligence expert. So you've got, call it $250,000 to spend, $500,000 to spend, $1 million to spend. Don't worry about the quantum too much. Right. What are you doing right now? You said at the top of this call that you used to be all in on content. You've been doing this since 2008. You've now got a due diligence business, but I see you on LinkedIn all the time. You're actively buying. Yeah. So in this particular climate, what are you looking for and why?
Very good question. So I am looking for very old, aged e-commerce businesses that have a few things, not a seller-owned warehouse or a specific warehouse they're managing in their city where they live, but a 3PL. So that's a pick-pack warehouse that's outsourced. I'm looking for that. I'm looking for very stable, essentially within the e-commerce, those marketing channels that I can't replicate, again, eyeballs, right? So those kind of businesses. So I'm looking 10, 20-year-old e-commerce businesses that have been around. We are now partnering on a 25-year-old, $16 million consumable goods e-commerce business that has been around for so long, it's not going anywhere, right? Things like that. Then I'm looking at service-based agencies. So there's been a push post-COVID, a lot of people entered the online space. There was a big boom in multiples, valuations, and then AI hit. And there's some of those folks have gone into physical businesses like real HVAC, plumbing, those kind of businesses. Nothing wrong with that. I have not entered that space. However, the same equivalent to that is agencies, B2B service-based marketing agencies offering services to those local businesses. It could be social media management, SEO management, paid advertising, whatever, right? Services that those local businesses cannot do. So I buy a lot of those. I have like at least 7 or 10 of those in my portfolio right now, and I continuously look. Then I look at tack-on businesses, bolt-on acquisitions, which are either going to be software companies or something that can help my portfolio grow. So I'm not looking for standalone software companies that I can run because I see more cash flow opportunities on the service-based businesses, but I'm looking for maybe a tool that I can buy that can help my agencies grow. Right? Either I can buy that for the eyeball, so it's self-sustaining revenue, and then it can be tacked on to my service agency. And essentially, those are the 3 types of asset classes I am looking at. I am not in the content. I don't buy content websites anymore. So that's done.
So one of the things that you've mentioned throughout this is age. So just everyone listening in, you've heard it. Age is defensible.
Yes.
If something has consistently performed over a long period of time, and particularly if it's consistently performed over the last 24 months and it's equivalent to its, prior 10-year performance, bet your bottom dollar that business is quite defensible and will continue on. And then the other thing that Mushfiq has reiterated many, many times over that he goes through in his own due diligence process, as well as through the process that WebAcquisition would run for you, is marketing channels, the breakdown of those, and whether there's any concentration or strengths and weaknesses of one versus the other. Mushfiq, let's kick into some questions here. There is a lot that have come through. So first one is, I can see here, let me make sure I get through these in order. How do we validate And what are the reliable ways to validate traffic, revenue quality, and operational performance when AI tools can artificially inflate metrics?
Okay, so traffic, the source of truth is Google Analytics. If you're buying the business that doesn't have Google Analytics installed, you should not buy that business, but in general. So get access to Google Analytics. And any buyer should be able to add you without having an LOI in play. They give you guest access. You can dig through everything. Now, if you don't have the skill sets to dig through everything, you can use AI. Just export a PDF, give it to AI so they can at least give you the basics. Again, what's going to be missing from the buyer side is you don't know what a number means, right? In reference to another business. So that's where a due diligence specialist can help. So that's where you're going to have some gaps, but at least you can get a high level, right? So traffic quality is going to come from Google Analytics. Revenue quality is obviously the P&L is going to give you the breakdown of percentages from various revenues. You can ask the seller to give you access to Shopify if it's an e-commerce business to look at the revenues, the recurring revenue there, the breakdown of customers, how many customers are ordering. All of that stuff is in Shopify. If it's a software company, then Stripe, you can get access to that. So that's going to give you those metrics. And then what was the third one?
The third one, my apologies, in that particular question was operational performance.
Operational in terms of team or those kind of things or software. Yeah. That's so P&Ls hide a lot of that because they categorize everything like software and subscriptions in one line item. You have to ask for the breakdown. Which softwares are being used? Are these third-party softwares or something they built in-house? We have seen some companies where the seller has built in-house software, nothing wrong with that, but they put it in one line item and they put a cost associated with the fact that if this was a outside software, this is how much you would have to pay, which is weird, right? They built it in-house. So that's those kind of things you can only capture if you get access to QuickBooks or Xero or the accounting software and just dig deeper into that, or just ask the seller, what softwares are you using? And then another thing we like to is contractor wages, employee wages. Again, those are just line items, right? You have to ask them, what's the hourly rate? What's their W-2 salary? And all those things is part of due diligence as well.
Don't be afraid to ask dumb questions, everyone listening out there. So ask as many questions about absolutely anything you want to the business broker directly. Right. And that business broker's responsibility is to go and get your answers to those questions. Right. Once you feel comfortable and content with the deal, you can put forward the LOI. And after that point, you can contract with Mushfiq's company to get comprehensive due diligence complete. So right. I just want to make that point because a lot of the questions here relate to doing due diligence yourself. You can actually do that, but it's just a bit risky. You're better off asking as many questions as you possibly want, assembling a view, coming up with a view as to how you determine the quality of that business, complete the LOI, put the terms of the deal in place, and then go and complete due diligence through a professional service.
So can I add one thing on that? So there are buyers that hire us pre-LOI. So Let me explain how that works. Is they come to us and say, Mushfiq, there's 3 businesses I like. We do a preliminary analysis on those 3 businesses and tell them, all right, this one is better than this because of these reasons. And then they say, okay, I need help, because putting together a deal structure at LOI is the most valuable. That is the time you get the best deal. So they hire us to structure the deal, do a preliminary analysis, and usually we 100% cover the cost of our services when we structure the deal, because we know what's going to work, what kind of seller financing, what kind of earn out, minimum cash down to get that deal under LOI. Then we get into due diligence and help them close. So there's 2 different types of buyers, that the ones that want to do the LOI and get there. But oftentimes, whenever we look at an LOI in our valuation report, essentially in our due diligence report post LOI, we add a section in there saying what we would have paid for this business if we, myself, were buying that business. And oftentimes they overpaid, and there's nothing you can do at that stage, either back out or renegotiate, and that leaves a bad taste. Like, that's just not the right thing to do.
Okay. How do you verify quality of earnings without spending a lot of money evaluating each deal?
Yeah, no, very good question. Quality earnings is an expensive, and it's because a very sophisticated CPA is involved with our team. Like, it's a very expensive survey. It can cost you $5,000 to $20,000 per deal. So you can, and I highly recommend you do 80% of the work yourself. So what we do in quality earnings, we get 2 years of bank statements. So everything is 2 years plus year to date. So we get all the bank statements. We get the accounting records from QuickBooks and Xero. We get the tax statements, right? You should be looking at all of that. Is the cash actually flowing to the bank accounts? And is that cash actually showing up in the P&L that you're paying the valuation? That's basic math. It's just forensic analysis, just time. You just got to spend time to make sure the money flows. And that's 80% of quality earnings. So you can do that yourself.
Okay. Just going to quickly answer Andrea's question here, addressing the transition of accounts with Amazon. I've heard that transfer can be difficult. Yes, it is difficult, Andrea. Excuse me. So obviously you can buy an FBA business. Strictly speaking, Amazon states that that's against their terms of use and policies. However, clearly, FBA acquisition and FBA M&A is an established industry. In fact, there's companies all over the world that have raised hundreds of millions of dollars just for that particular purpose. So the key thing is that you either work through the processes with Amazon, i.e. contact Amazon via the support environment, which the business owner can do, and the business owner needs to state categorically that they're selling their business. You can also use a transfer service. And so much like Mushfiq is a accredited due diligence partner for Flippa, we also have a partner called Seller Candy, and their entire business model is around transferring Amazon accounts. Quick one, Mushfiq, on AI vendors in the event that you've come across this. So Brandon says, how should buyers evaluate risk when a business relies heavily on a single AI vendor? What do you think about that? I mean, from our perspective here at Flippa, I can tell you we use multiple vendors, and we essentially look at the cost of each vendor for the task or the workflow that we're looking to run, and then we look at it from that perspective. Is it simply like any other cost in a business where you just assess whether there's an alternative that can be done for the same quality at a lower cost?
Yeah, so we use all the vendors. We have custom workflows just like Flippa on different vendors. And when we hit a bottleneck, and the bottleneck is not just like it's a vendor going out of business, which all of these are, at their group. I mean, OpenAI, Anthropic, they'll be around for a while. Bottleneck is the quality of the output decreases for whatever reason, an update they did. We are able to shift over to another vendor pretty quickly, right? It takes work, but it is horizontally you can shift over. So I don't think that risk exists today. It's not something that's like, the major risk. It could be a minor risk. So it's not something I would worry about.
Okay. And sorry, I'm just taking a note on that. An obvious question: how does WebAcquisition price its service? I'm sure you can answer that.
Yeah, it's on a case-by-case basis and a business model. But usually our technical marketing reports start at around 3,000 and go up to 8,000, depending on complexity. Our quality of earnings are about 4,000 up to 8,000, something around that range.
Okay. I do like Jeremiah's question here. What would you consider the top 3 skills that a new, inexperienced owner must have at the beginning and post-acquisition?
So, yeah, let's assume that the owner should have some skills. I mean, you're buying a business, you had a past career, you did something. So try to find something where it aligns with your skills or your interests. That's first. Now, you could have a team in-house that you hire, but usually if you buy a big enough business, $1 million, okay, let's say 500,000 plus in valuation, it will come with an existing team. It should come with an existing team. If it's not, that's not a business that you should buy, because you're buying a job at that stage. You're not buying a business. So those team members, you have to evaluate them, make sure that they're legitimate. Now, it's very hard for me to sit here and say the top 3 skills, because it's very dependent on the type of business. If it's an FBA business, you need somebody who knows FBA. You need somebody who knows pay-per-click and FBA. If it's an e-commerce, you need somebody who knows Google Ads. So I would create a list of 10 skills that are interchangeable. Like you need a paid specialist, SEO, social media, and then figure out where those skills fit into that business, and then figure out if that business has those skill sets already through the employees, or if you need to go hire. I still hire everybody from Upwork in my businesses. It's a very good platform. You can hire the best in the world for very affordable rates, and that's how I hire. And labor should not be a reason you don't buy a business in today's environment. Skills are people with skills are available all over the world. You can hire pretty easily.
Okay. Here we go. I like this as a question to wrap up. I'll see if there's any others that come through while we're doing this. Mushfiq, if you had to boil everything down, what is the single most important shift buyers need to make in their diligence approach to stay ahead in an AI-driven M&A environment?
So what are the things they need to, can you say that again? So what is the single most important shift? I think what Brandon's probably saying there is, I want to buy something. Right. Everything looks pretty interesting on paper. Maybe I know a little bit about the old diligence approach, but now in an era of AI, what should I be worried about? Is my business likely to be disrupted? Right. Is the revenue more challenged than ever before? Is my marketing costs likely to go up as a result of AI? Is my traffic likely to go down? What's the single most important thing that you think that buyers in 2020, what are we in? 2026, what do we need to know? Yeah. So I think the answer comes down to, is AI going to affect my eyeballs that come to that business? I keep saying that, and I keep repeating it. You are buying a business for the eyeballs. So just look at, is there anything that can impact that? For example, if it's a website with mostly organic search traffic, absolutely AI is going to impact that. Is it social media? AI has an impact on that. It's just, you have to categorize how much percentage impact that is historically, right? And what do you think the future is? Unfortunately, digital assets, digital businesses are high risk. Everybody knows that we're here for that. It's a high risk asset class in general. And so AI is going to have an impact. You just have to categorize how much of an impact, and just make sure that when you buy the business, those eyeballs will continue to come, and you categorize that risk, right? That's why deal structure is really important, right? Earnouts are important, seller financing is important. Keeping the seller involved is important because they know secrets you don't, right? And they've navigated this space. So it's a combination of you being comfortable, how you're going to continue to get those eyeballs, and then also structuring the deal so that it covers you in the worst case. So yeah, I'll stop there.
Yeah, I think this is a really important question, and I guess speaks to the whole reason we're on here today, which is that clearly the world is changing, but really what you're looking for is, do I trust that the revenue that this business is generating will continue to generate that same amount of revenue post-acquisition? And the best way to think about that is to go through, as Mushfiq has said multiple times, how does it actually derive that revenue? Right. Is it a function of organic search? Is it winning traffic through the LLMs? Is it a function of a strong affiliate and referral program network where there's 5, 10, 100 people sending customers there, and those customers have to be high quality customers? Right. Is it a function of email marketing? So you really want to know how it generates the revenue it generates today, and you need to make an informed decision as to whether those channels are reliable into the future. And again, that's where longevity matters. If it's been doing it for a very long time, it's highly unlikely that it stops doing it. Right. But if it's short-lived and the marketing tactic is just that, it's a tactic versus a strategy, it's something you might want to question. Right. All right. Well, hopefully that's been super helpful to you all. There's a bunch of other questions. So I'm going to take those on notice, and we're going to send out a bit of a Q&A. So we're going to take all of the questions down, and we're going to send everyone the questions we received and our written answers to those. So you won't miss out. Thank you for the questions as they keep on coming in. We appreciate you dialing in. And Mushfiq, thank you so much for your time. I really do appreciate you joining us.
Thank you so much.
Take care. Bye-bye.